I want to talk about the art of trading, the forgiving spread. Now, the art of trading is a very broad range of different types of trading. You can make it just as complicated as you want to, or just as simple as you want to. And over the years, what I found is traders tend to gravitate naturally, but toward the more complicated and more sophisticated things, and it's not a great way to start. So what I want to propose to you today is a way that you can either start or restart your trading if you've not found the level of success that you desire. I'm going to be talking specifically about something that I call the forgiving spread. It's sure you are familiar with options, but you may not be aware of how this spread actually out and can benefit you. So without delay, in a second. All right, so my experience, as Reed mentioned, I've traded for 5 years. I've traded futures, commodity stocks, and options. I remember the day I walked out of my house in Maui for vacation, and I had a stack of junk, and I just grabbed it and took it with me, and I was sitting by the pool in Maui, and I started to read trading futures. I started to read about trading commodities, and I started to attend that really launched my career in learning how to trade. Last years, I've traded options exclusively, and I've really gravitated to options because of the flexibility and the simplicity that they offer. And a lot of people will tell you that options are really risky, and that be the case unless you have a real solid understanding of what you're doing with them. Today I'm as a teacher, a trading coach, and a trader. I've taught hundreds of traders since 2000. I teach traders every single day, and I coach traders every single day. And I'm actively involved in the markets every single day. So when I'm working with traders or I'm them in one of our daily updates, I'm based on what's currently going on in the market, not something that was a concept that was created, built into maybe a PowerPoint or so. It's really based on true market condition in the moment. My company, Options Moneymaker, we work on strategy design. We non-strategies because not everybody is sophisticated enough or knowledgeable enough, experienced enough to really grasp the art of understanding directional bias and practice directional trades. We have a desire to work with trading strategies and teach trading strategies that are relatively simple, even though on the surface they may seem complicated, but when you start to understand them, they're pretty easy to use, that they have the ability to profits and that we can have some fun while we're trading. In the introduction, I mentioned lifestyle freedom, and that's a big deal to me. I spent 25 years in Corca, committed to the job that I had and loved what I did, but I always wanted to be able to do what I did from anywhere. I wanted to be able to choose where I live. I wanted to be able to where I travel. And I have that flexibility today with the business, and any one of you can have that same level of flexibility as a trader, because you can trade from anywhere as long as you have a connection, a laptop or a phone. And that, to me, is even important than financial independence. I want to have financial independence, but anything that restricts me, it's not as much fun. So lifestyle freedom is. Now, we focus a lot on what causes trading anxiety, because if we can dissect what level of anxiety that is so prevalent nowadays, then we can help traders massively by isolating specific areas that they need to focus on. In no order, I won't go through all of these, but the two I want to highlight are capital commitment. They start to get anxious about their trade when they have committed too much capital. And always get into the trade and they're willing to load up, load the wagon, they're willing to, and it starts going south on them. If they have no understanding of how to manage the trade and they have overcommitted their capital, they start to get very anxious get very near the trade, and it doesn't feel very good. And most traders, I find, are very short-term focused. They need it now. They want it now. They're trying to tell the market what to do instead of what the market is offering them in the way of an opportunity. So I'm going to talk a little bit about it's implied and embedded in the topic that I want to share with you today. Keeping it simple. Now, I'm a big believer that when people are learning, and you could be an experienced trader that you have a desire to learn a strategy that we teach, or you could be a brand new options trader and you just are starting from scratch. Regardless of what your motivation is, when you're learning something new, keeping it simple and keeping it a point where you focus on exactly what it is that you're doing and not be distracted by a lot of other factors is absolutely one of the most beneficial ways for you to learn. Now, what I had the privilege of doing when I was in my old corporate job is I ran a learning organization. And we were familiar that our associates, I had over 2,000 associates that I was responsible for. We had to teach them to be effective at their job. We had to teach them to be successful. And it was not just to teach them in a way that they could not succeed. So we've designed a lot of the things about adult learning and that learning organization into what money. And we try to help drive traders to where they be consistently successful, and as they learn and feel confident, then they can layer on things they'll learn, but start somewhere. So the keeping it simple is embedded in time. And what I want to guide you through is a concept about trading a single strategy and a single position. We're short-term positions, but we're only going to trade one position at a time. It's a great way is pinpoint focused on what you're doing, and by trading a single strategy through months, you start to understand how that position reacts to different market conditions. I'm going to show you today in an example of what can happen when you're focused with your overall trading. So the strategy that I want to talk about today, market tamer. Now, it's a perfect strategy in our opinion to use as the single strategy approach to trading. It's a relatively simple strategy for all traders. As long as you understand the basic characteristics of options, like the time to expirations, strikes, then you certainly can participate in trading. It has a relatively short hold time. It averages about, and if you commit just 15 minutes per day to review your position, that's really all that's necessary to successfully trade. Now, I know it's about 15 minutes per day to review because one of the services that we offer is I do a analysis of whatever position we have open, and I record that analysis, and it takes me about 15 minutes. Now, sometimes I get a little long-winded. It might be 12. The gist of this is you can carve out 15 to 20 minutes per day, whether you have a job, whether you own a business, have a family life you choose to do. If you have a desire and you can fit it into your day with this type of approach. The other thing is there's no technical skills required for a market tamer. Now, I am a huge believer as a charting is an important aspect of successful trading. But what I desire is a strategy that would allow traders, especially newer traders or traders who have never done technicals, to be successful and not have to necessarily wait and experience and comfort level with technical charting skills, really significant charting. We also trade the indexes. Now, this market, you can trade stocks, it can be used to trade ETFs, but we trade index, no fundamental analysis required, so we've eliminated one more element of being to get to speed in trading successfully. And the other thing about trading the indexes is if you focus on the same index over and over, you become intimately aware of how they perform and how this type of strategy will respond to different market conditions. And then the market is designed to require relatively simple adjustments, no significant management. It's designed to leverage the cycles of an equity. So we trade the NASDAQ 100, and we trade it quite extensively. And the NASDAQ 100 moves down, and it can have an overall trend that is trending higher or trending lower. In that trend, it can move, 100 points, 200 points over the up and down. We leverage those cycles. We take advantage of decaying time of options. If you're an options trader at all, you're very familiar with the decaying time value of options, and put on your side of the equation so that it benefits you, then you're that closer to being able to understand fully how to trade a market tamer strategy. But absolutely number one critical for us in terms of the success of a market tamer. Market tamer strategy is designed to earn profits regardless of market direction. Now, understand me, I'm not guaranteeing a profit regardless of market direction. I'm saying that it is designed to offer you an opportunity for profits, direct moves. You can open a market tamer position and not care if the market is bias up or bias down. You don't have to have strong charting skills in order to determine. You literally don't care once you've opened a market tamer which direction the market or your particular is going to move. It's also designed to be a short-term high-profit trade. Now let me say that my definition of short-term is about 5 days on average. Of high profit is about 12% on average. So short 5 days to high profit is about 12%. And generally we're somewhere in the 10% range on each of the trades, and generally we're somewhere in the range on our hold time, but its average is about 5 days. Adjustments. We want to eliminate fear. We want to eliminate panicked exits, that nauseous anxiety that plagues so many traders when something starts to they really don't deal with it, and so they bail out in a panic. And we don't want you to wake up in the night we're about to lose a bunch of money. So what I want to discuss now is how a market tamer position is constructed, and then I want to talk to you about the forgiving aspect of this presentation. A market tamer consists of two calendars. Okay, it's a relatively simple concept, and if you've traded calendar spreads, you know that it's with two option legs where you're buying one and you're selling one, and the one that is using an expiration that is closer to today than the one that you're buying, and the strikes on both legs. So what we do is we market by putting together a call calendar spread and a put calendar spread. So we care which direction the market's going to move. Now, on the surface, it seems a little advanced, a simple strategy. We have people joining us every single day are participating in trading the market tamer, and they come from all ranges of experience. It also allows you an opportunity to use either monthly or weekly expirations, which gives stability. And you can trade, as I said, any equity using the market tamer. The really fun for our simple approach to trading, our NDX and UT. So we've got the NASDAQ 100, the index, SP, and RUT, which is the Russell 2000. This also keeps, because you're not constantly scanning the entire feed available and equities. You're focused very on these three indexes, and I'm going to show you, actually we have a program literally focused on the NDX. Now the forgiveness associated with the calendar spread is huge, and that's why it works so well in its market tamer. So let me first of all share with you what that forgiveness factor is, and then I'll lead you into a market tamer position and show you why it works so well. So here's still downward spread. Let's just say that we wanted to open a put calendar spread. We thought that there was a bias down in the market, so we opened a put calendar spread. We bought to open a November week 2 expiration. We sold November week 1, and the strikes on both legs are the 4,005 NDX. We paid $50.15 for the put, and we took a credit of $37.50 for the short put. So $12.65 of cost in putting this trade on, and the delta value of the long leg is 0.44, and I'm going to explain to you in what my delta on the long leg is. It's important. So this trade is set up from down, okay? Puts generally benefit from a move down. Buy and sell a put and are constructing a debit spread or a calendar spread, it benefits from a move down. But this trade has a forgiveness factor built into it. If NDX moved instead, we still could potentially make So here's what I'm going to give you is a an academic script, a necessarily real-world description, but I want you to understand to what a real-world application would be on this. So here's our position: the 40-25, and we're short the 40-25 put. Week 2 on the short. If we got to expiration of 1 and we were trading above 40-25 and we realized the index moving down, the index had moved up. It had literally moved again position. What would happen is that short 40-25 would expire, and that means we would have a profit of $37.50. We sold it for $37.50 originally, and if it is out of the money and are worthless, then we get to keep all of that as profit. But when we keep that 50 as the short leg, it means that we can afford to lose that amount of money on the leg and basically be able to exit out of this trade for no loss. Now, having no profit on a trade is not what we desire, but a long trade is absolutely what we desire, and so we construct our options as much as possible to have some forgiveness built into them. We can figure out if we actually move if, in fact, it moved against us to cap our loss on the long leg at 37.50. Long leg has a delta of 0.44. Now, very simply, the delta is just telling us ultimately how much the value of the option is going to change for each one change in the index. So it means that if the index goes up 10, the value of the long put is going to change by 4 cents. It's 44 cents for each $1 move. So if the index if the index moves up, I want to correct that, 85 points, then the long leg will lose 87.50. That's because 85.22 of 0.44 equals 37.50. So although you set up a bias trade, anything less than an 85-point move against your might actually still have the opportunity. You set up a declining bias thought going to go down, and all of a sudden the market is moving against you, and instead of panicking, monitor trade each day, say, all right, well, you know what, I know that NDX can move up 85 from where I position, and I still have the potential of closing or possibly a profit. That gives me a lot of confidence in type of trading because I don't have to panic. I don't have to immediately react when there is a move against. Take the concept of that forgiveness factor on a calendar spread and construct a market tamer by putting together both a call calendar spread and a put calendar. We open them simultaneously. It eliminates the need for directional bias. This is set up to profit regardless of which direction. One side wins on the move. You know that the NDX is going to move one direction or the other, but one side wins and benefits from that forgiveness factor. Both sides benefit from time value on the short legs that we sell. So let's NDX market tamer position. I'm going to walk through the construction of it. I'm going to give you an idea of what the setting up the trade are and give you an example of a position. So not important. We don't even need to look at a chart. Most of the time we don't look at a chart when we're setting up market tamers. And yet we have a course through our education program where we teach tech charting, but we don't apply that to market tamers. Balancing the delta values of the long call put is critical. They need to be reasonably similar, and I'll give you an I mean by that. And then we're going to create something that we refer to as a sweet spot. It is somewhere between 50 to 200 points in range. That is the gap call and the put strikes. It's going to be generally on NDX somewhere between 50 to 100. We're going to choose our expirations. First of all, the long expiration needs 6 weeks out. That's the expiration that we buy to open, the leg that we buy to open. Then the expiration of the short leg, the one that we sell to, need to be 1 to 3 weeks out. Okay, so now although they're both overlapping at 3 weeks on the setup, you never have them in the that are somewhere between 25 to 100 points out of the month. These ranges are specific to NDX. We have other ranges we use for SPX and other use for RUT, but I'm going to give you the basic understanding of what market tamer can do based on an NDX trade. And it's the most frequent in trade. We're going to assess the delta value of the long strikes. I'm going to give you specifics. This is up here. We're going to assess the delta value of the long strikes. If the delta of the long call, delta of the long put are not reasonably similar, we need to adjust strikes so that we have them be as close as possible. But we want them to be as close as possible. Now, a good guide, a debit. This is going to be an overall debit to open a market tamer, and a good guideline is that you're going to spend somewhere between $15 and $30 to open a position. A key for constructing a market tamer properly is that the receipt on the short legs, the legs that you sell, the sell to open, sell to open, the credit should be greater than the overall basis of the flagged position. So if my cost basis to open all 4 legs when I factor 2 credits, if it was 1980 and my short credit 37.35, that right there is a great construction of a market tamer. Why to you here in just a moment. The big credits give you a lot of room to work with on the trade, allowing for decaying time on the longs, which you are going to experience, and we refer to that. So here's a specific position. Okay, this is an NDX when I put this slide together yesterday, and I was updating position. NDX closed at 40.46 yesterday, so I based it on a position yesterday. We would buy to open week 2, November week 2, and sell to open November week 1. My expirations is because yesterday we were in October week 5, the beginning of October week 5. So by selling to November, I literally have 2 weeks to expiration, and then I go out 1 additional week and buy a long leg. So I'm using November week 2 on the longs, November week 1 on the shorts. I opened the 41.10 calls, and I sold to open the 75 puts. Sorry, bought to open this call spread at 41 and the 39.75 put spread. These are both calendar spreads, 7 put calendar spread and 41.10 call calendar spread. These are the debits that we took on each leg, and these are the delta bets on the call and the long put. So when I went 70 points or so out of the money as my deltas, and realized that the delta values were reasonably similar, they're very similar, very, very close, and so that is a measurement not on this trade properly. The total cost of this was $20.70. My longs cost me $70, and my shorts brought in a credit of $39. So I have $89 credit against a total risk on the position of $20.70. That on the shorts against the total risk on the entire trade that I referred to just a few is a huge opportunity for us just waiting, and that's why as well as it does. This position can be profitable if NDX is down or if it remains flat near the current price. Time decay is the primary driver of closing the entire position for a profit. Now, I trade the weeklies every single week. Every single week I have an NDX position, and that's under a program that I'll share with you. We generally have an NDX, an SPX, and an RUT every single week, and we just roll 1 week to the next and compound our profits. So what could possibly happen to this position? Now, the sweet spot. And the definition of the sweet spot is that range in the put strikes and the call strikes. 39.75 for 10. We have a huge range here. Okay? Sweet spot X remains inside that sweet spot until the short legs. Then what would happen? Well, put is going to appear worthless, and we would have a profit of $22.65 because that's what we sold the put for originally. The short call will also expire worthless, and we would have an additional of $16.35 because that's what we sold it for originally. Now that happened, we carried this all the way through to expiration of the shorts. I'm going to tell you that we never do that. I shouldn't say never, but we carry a position all the way through to expiration of the shorts. So what I'm giving you here is just for them to understand the concept, and then we're going to back into what would be more realistic. But if we find that sweet spot and we could afford to let both the short put and the short call expire worthless, and we keep all of that credit as profit, profit. But now we're going to be very realistic about what happens. The long and the long put actually have their own amount of gain value. They decay also. They just don't decay at the same rate that the short decay. So we have to anticipate that we will have use of the long call and long put. Slippage is generally a result of decay and changes in volatility. Now, if volatility decreases while you're holding, you're going to incur slippage because the overall value is to deflate as volatility decreases. If volatility increases while you're holding this position, you will actually have a situation where you may have what we call traction on the longs, where instead of experiencing slippage, you actually experience an increased value on the long legs. That's common. For our exercise, I want to point out what would happen in this position if we through declining volatility as well as gaining time. We're going to, for the sake on this for the past 5 years, and 50% slippage is enormous slippage that I don't believe I ever remember seeing before. So what I'm giving you here is an example of something that generally doesn't occur, but I want to emphasize the point of how these trades play out. So we're going to assume that we now have to absorb a $29.85 loss on the long legs that we would then net against the gains that we see on the two short legs. Net all that together, we are out of the short legs and we've closed the long legs for a loss, and our net overall profit is $9.15. Now that's against a total risk of $20.70. That's what the position cost us to put on, which is a 44% return. So that's not too bad if you hold for 2 weeks. It is real in a very comfortable, non-threatening academic situation here as we're evaluating this position. It is real, but I will tell you right now that I would never choose to hold this position that long to try to get 44%. What our experience tells us is that there's no reason to be greedy or to increase the amount of risk in the trade. Instead, could exit this trade somewhere between 10 to 20%. We typically use 10 to 20% as our comfort zone in terms of exiting. Because if I choose to exit at 10 to 20%, that I can be out of the trade well before expiration. I don't have to run the risk of managing the trade. I don't have to run additional risk of it potentially moving out sweet and causing additional adjustments that I might have to make. The longer I trade, the greater the chance of needing to manage as well as slipping from the longs. If I choose to just exit out between 10 to 20%, I won't have to. I'm leaving a lot of money on the table. I realize that, but that's the way we. I would rather take somewhere between a 10 to 20% profit every single week, get a brand new trade. And that's the way these market tamer trades work. Time decay is working for you even as the index is against one side. Remember, one side of this trade is going to be profitable, and the other side of the trade has the forgiveness factor built in both sides that could potentially make money for it. When done properly, the short credits, the credits you're going to get on the short put and all, will provide profits as well as offset slippage longs. Now, just to emphasize, that's exactly why we like to build the credit on shorts is huge compared to the overall debit position. You're basically building into the position an opportunity to close the loss and not care, but still have enough time value decay on the due to a reasonable profit level. Now, what's so cool about the market tamer and the account version of the market tamer that has that forgiveness factor built in is that the move doesn't matter. You know, in our example, we did between 75 and 41.10. If it moves up to 400, which it did, it still is inside the sweet spot. It could just as easily move down 30 or 4,000 inside the sweet spot. The minute it moves outside the sweet spot, there's a very simple we follow to manage it, and it allows us to stay in the trade and actually in time value that we have in the trade as we remain in it. And the forgiveness factor on the counter spread absolutely makes it an ideal stream for a non-directional market tamer approach. We teach traders how to simplify their trading. Now, we don't always keep it simple, by the way. We like to start people so that they can feel with what we want a single strategy approach so that we simplify into a single approach that you need to focus on. If you trade for 6 months, you're going to really start to understand week after week after week how this plays out in different market conditions. If you develop in your understanding, a single position approach can reduce anxiety, fusion, eliminate direction, and you're going to have a lot more fun trading. I'm out of time here. I do see a question, Gary, asking you use Qs. Yeah, this strategy can be used on most any equity. We prefer just the size of the credits that we get and the reliability of those credits. But let me with you how you can participate in what we're doing here. The options money firms, it really focuses on this simplicity is Code 20. And it is an education program. It is not just a trade education program. It's designed to teach you how to trade successfully. We start with $20,000 of capital. We initially allocate about $7,500 of our $20,000 and balances in case we need to make adjustments. Now that's a lot of reserve for adjustments. We're likely to need that much, but we're trying to be conservative about what we're doing. We don't be anxious the capital that we have in play. We do a 15-minute daily position that for everybody. I do an analysis, and our intention then is to compound 50% of the profits into munitions. Our win-loss ratio, based on 3 years of live trade. I've traded 5 years, but the first couple of years I really worked through a lot of different variations of it. In the last 3 years I've really perfected and honed in on the rules most of it. And our win-loss ratio for the last 3 years is 10% wins, 10% losses. And over that 3-year period, we averaged 12 return per position, and we were in these trades for an average of 5 days. Carry that forward. I want to qualify this. I think everybody has heard the disclaimer and understands that those experiences historically are not guarantees that you're going to experience the same thing. Just a what-if scenario for you. What if you did assume going forward 12% return And what if you assume loss out of every 10 trades, and we assume 20% loss, virtual loss, and we assume that we compound 50% of our profits in trade. This $20,000 grows into after trades. Ultimately, we would like to grow our $20,000 Grow 20 account. Now, this tells me that we can do it in 104 trades based on assumption. I don't know if we can do it in 104 trades. I don't know that we can assume that we're going to continue at 12, 9 wins. I don't know that. But what I do know is that we can be patient and diligent, and we can apply our skills every single day in analyzing our position and take what the market gives to us. Perhaps it'll take 104 trades there. I don't know. Perhaps it'll take 104 trades, but trades in weeks instead of 1 week. I don't know yet. But what I do know is with we're going to trade every single week, and our ultimate objective is to present $2 million, and we'll see how that works out. We believe this is a very powerful way to small thing. If this is of interest to you, and this is my last slide, I know I'm over just a couple of minutes here, and then see if there are any quick questions. The Grow 20 program education supported by real-time alerts. It consists of 10 hours of upfront video on the market. Now you're going to learn multiple variations of the market tamer strategy through those 10 hours, but we promote through the Grow 20 just the calendar spread variation. We include in the registration for the education a 6th free subscription to our Grow 20 alert service, and that consists of alerts when we're opening, closing, or adjusting trades. We'll email them, text them to you, whatever. Also provide that daily position review for your continuing education. As an old-time learning education leader, there's nothing more valuable than learning up front and then having a little hand-holding for a period of time and understanding on a very frequent basis what you do practically. So this is your continuing education. It's 5 days a week for 6 months. We're going to tell you exactly what we're doing with this position. We're going to translate what you learned through these 10 hours of videos into real-time analysis of what's going on in the NDX and what's going on with that market tamer position. If this is something that interests you, the participation fee is $14.95. Most all of our subscribers that have signed up to date have already earned back their $14.95. You can visit us at optionsmoneymaker.com/grow20 to sign up. If you have questions about it, feel free to email me, mark@optionsmoneymaker.com, MARK@optionsmoneymaker.com.